The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome everyone to a new episode of This Week in Intelligent Investing. Great to have you with us and great to have my co-hosts, Elliot Turner and Phil Ordway. Elliot, let's kick it off with you.
All right. So, this is called This Week in Intelligent Investing, and thematically, we're supposed to talk about, long-term wisdom, but also what's relevant today. And every once in a while, the investment world coalesces around one point of tension. And we're at one of those foremost junctures right now, I think, with the debate about inflation and the Fed policy shift, and whether this is something that is, call it transitory, or something more enduring. A change in the status, effectively the status quo on the inflation or disinflation front of the last couple decades. And, I thought I'd try to take my stab at a couple things, lay out some scenarios, and hear some feedback from John and Phil and see where this takes us. So one of the things that really caught my eyes, and we'll share this chart in the show notes, is if you look at real expenditures on goods and services going back 20 years, it's fairly consistent. You could obviously see the recession following the financial crisis, and the impact there was far more acute on goods than it was services. In other words, most of the recession was in goods, though where you could see it clearly in services is that there had been a pretty consistent trend, and that trend broke, right? So it didn't decline as much as goods. But for the most part, if you smooth it out, goods and services had been on a fairly consistent trend for, 20 years heading into January of 2020. And in that trend, goods had actually been gaining on services in real expenditures. And suddenly, with COVID, you see everything fall off a cliff. And then with the normalization, goods demand soared. And services demand very slowly inched its way back. So to put numbers to it, the demand for goods at its peak in the post-COVID period was over 20% higher than it was before COVID. And today, at the highest level of services post-COVID, it's still down about 3 to 5% from where it was heading into COVID. So, let me state it clearly. Goods demand soared well above trend. Services demand dropped and has not yet recouped its trend. And so when you think about what that does and what it means for inflation, our economy was built to handle a slow and steady grind upward in the volume of goods. And you suddenly have a step change in the demand for goods. And when you think about what that does, in those old supply demand charts from your economics classes, that step change, outward in the demand curve drives price upward. And so the big question becomes, do these things normalize? And if they do normalize, if services demand returns at the expense of goods demand, you get to a more balanced economy. And perhaps you even had big investment in handling this new volume of supplies on the good side that makes it even perhaps disinflationary on the other side for goods in particular. And I think that's an interesting debate, and it's something that I've been wondering a lot about. And it's hard not to believe, when you think about services, arts, entertainment, recreation, travel, even a lot of healthcare, people are putting off routine doctor visits, like general practitioners, revenues are down quite a bit. Services have really been taking a beating. And, you may have traded a vacation to the islands for a living room couch and a new TV, putting further pressure upward on goods, right? But that's not going to be the case forever. And so, I think that's a really important framing for the inflation debate. If you believe that this is something other than transitory and this is more pernicious, you need to believe that there's something more pernicious in this surge in demand for goods and something more prolonged in what it takes to get to a more balanced economy once again. And then the second big debate is around, labor and what that has, what that means for inflation. And I do think, this changing composition put similar pressures on staffing up for handling the volume of goods, which competes with, low wage jobs in the in the services space. And you also have the impacts of stimulus that drove some of the goods. But with labor, I think that's a little bit of a tougher nut to crack, because right now, one of the biggest problems, you see the Starbucks near me closed for a week, and it was because literally every person got sick in there who was working there with Omicron. And so you wonder what sort of strain and pressure that's putting and how long that'll last if we, obviously remain in this COVID environment for a prolonged period of time where things are very reactionary like this. It's going to last a lot longer than if it's not. One of the really interesting things that we need to think about is how the Fed's going to respond to all this. Are they going to treat it as something more pernicious and try to nip it in the bud and risk, putting the economy into a recession? Or are they going to try to walk a tightrope and communicate their intent while not actually while trying their best to not tip things over too far? And there was a quote that Powell had in his December press conference that really stood out to me, that I think was worth reflecting on and worth thinking about. So he said, in addition, when we communicate about what we're going to do, the markets move immediately in response to that. Financial conditions don't wait to change until things actually change. They change on the expectation of things happening. And I think what we've seen over the last couple of months is that, yeah, they sure do. And that's happened pretty quickly. So, I think he's also signaling that they will use communication. This is very consistent with what Bernanke said during the 2013 tapering period, where he emphasized the role of communication at the Fed. And that they're going to use that as their first lever, and perhaps they could achieve some of the tightening of conditions without actually going to policy tools. And so, I think it's really hard to picture and visualize, when inflation normalizes, how we get to a balance, because no one really knows what happens with COVID. But the last thing I'd say before throwing it out to you guys is there's this base rate effect that amplified the forces of inflation last year, having year-over-year comps versus a very disinflationary period, that will be harder to maintain the rates that we're seeing today as the base, as we lap year-over-year comps that are, what you'd call easy, and they get tougher and create a headwind on inflation. So I'm very much thinking it's transitory. I'm open-minded to being wrong. But, just wanted to set that out there and hear what you guys think, how you're thinking about this period of time and what happens next.
I think the word transitory will go down in infamy. I think it was kind of a throwaway description, for lack of a better word, that's been taken out in public and beaten like a dead horse over and over and over again. I mean, I guess it was ill-considered from that regard, but my biggest takeaway from it is I really don't care that much, because I always think about inflation. I want to be thinking about inflation more when other people aren't thinking about it, because that's probably when the risks are biggest. And so it's kind of funny to me in a way, I guess, to watch this all unfold, because a certain subsegment of people have been banging the hyperinflation drum since the first round of expansionary Fed balance sheet policies in 2007 and 2008. And I remember way back then being brand new to this world, thinking, wow, this is really kind of uncharted waters. It's never happened before. And a lot of the old timers just couldn't wrap their head around it for good reason, because they literally not contemplated it much. And it led a lot of people to take action on that basis, where they expected kind of immediate cause and effect inflation or hyperinflation in 2009, 2010, 2011, 2012. And of course, it didn't happen. And that was a great lesson in how complicated this really is. And I think the current environment is way more complicated than it was even back then. I mean, I could argue this all day from both sides and not come to even anything resembling a firm conclusion whatsoever. I think, as to the great debate of whether or not inflation will prove transitory or not, my answer is a firm both, or maybe, right? Because I think certain elements of it are like trying to put the genie back in the bottle. I don't think once you give people a raise, you can easily take that back, right? You basically have to fire people. And that's usually a last resort. Once you use a ton of monetary stimulus in the economy, that money's out there, and it's really hard to remove that money from the economy. And politicians and even Fed officials are very unwilling to do that. So that sort of stuff I would put in the permanent camp. But as a generally glass half full kind of person, I don't expect all of the impacts of COVID to last forever, in the sense that, the shocks to the system and the labor disruptions and all the supply chain stuff that can eventually be fixed, I do expect that to eventually get fixed. And so, that could help. I think the things that drove inflation so low for so many years, namely the deflationary, at least the disinflationary trends in a lot of the technology that we use every day, a lot of the labor market dynamics, the population and demographic situation, none of that's really changed, or at least as it pertains to inflation, it's been almost exacerbated or continued. So I think there's so much pull and push here that it's really hard to say. And so I'm actually writing about this literally as we are recording this today, about in my annual letter. And so what do you do as an investor? My short answer is avoid anything that's going to get killed if inflation were to continue and persist or accelerate. And that's kind of an evergreen statement and kind of a no kidding type statement. I mean, but I think it was forgotten for a long time because inflation was so quiescent for so many years. I do always enjoy finding a good company with pricing power, and that's probably never been more important than today. I mean, if inflation persists, there's no better defense against it than a company that can, grow its top line and protect its margin in real terms. And that's really hard in most commodity businesses. I write about treadmill spending, which is certainly not a concept I came up with, but it's a very important one, whereby you just have to spend ever more higher amounts of money in nominal terms just to keep up in real terms in the business world. I mean, that's a recipe for disaster in an inflationary world. So, those are kind of my answers to the question, but unfortunately, they're not really anything too definitive. Sorry.
Yeah, I guess to add a little bit of my own thoughts on this, even though I don't think we're going to solve anything in this discussion, maybe we can, just guide people a little bit as to what our thinking looks like here. But I think the word transitory is really misplaced, mainly because after a period of inflation, even if you go to zero inflation, you don't go back to the prior price level. Inflation this year increases the price level forever, unless we have the same amount of deflation in the following period. The cost of living has gone up forever. So calling it transitory is misleading, because for a lot of folks, especially that are not so well to do economically, they're going to have to be paying higher prices for forever. And chances are that we're going to keep having inflation. I think the only question is how much. It's also true, I mean, on the other hand, that productivity growth, innovation, and there are a lot of forces that are disinflationary. That's why we've had a couple of decades of very benign inflation. And there are some innovations coming down the pike that could be very disinflationary. I mean, if some of the innovations on the energy side pan out, like nuclear fusion or things like that, they're kind of science fiction right now, but there are some startups being funded in this area. I mean, if you could get super cheap energy, that would be hugely disinflationary. But we're clearly not there yet right now or anytime soon. And I think what I'm kind of observing is that no one I know is reducing their consumption, but everyone wants to reduce production. It's kind of like virtue signaling when you say we shouldn't be producing oil or burning coal or doing any of these things and don't invest in that. But none of us are really reducing our consumption of energy. And, it's just basic economics. If supply goes down, but demand does not, you're going to need to price a portion of the demand out of the market. And that is inflation. And lastly, I would just say that inflation may be one of those things where it doesn't really lend itself to being a total contrarian. Like, I'm going to worry about inflation when no one else is, because inflation actually can kind of gather its own momentum, and a future inflation is in part driven by inflation expectations. And so if everyone's talking about inflation, if everyone's worried about inflation, that is actually a risk factor to having higher inflation, because people are going to start demanding higher wages, raising prices, whatnot. And so it's not just empty talk. If everyone's worried about inflation, I think that kind of mindset can become endemic, and that after a while needs to get broken by really decisive action like Paul Volcker took. But obviously that's very far in the future if we get there.
I think that's what's so interesting is who's going to play the role of Paul Volcker if it becomes necessary, because I don't know if such a person exists. And I'm glad you clarified that, by the way, too, about the kind of inherent feedback loop of expectations as it pertains to inflation. That's an important point that I didn't touch on or should have addressed earlier, which is that I think maybe I'm wrong about this. There's no way to really quantify, but it certainly seems like when you look at consumer surveys and kind of sample the zeitgeist out there, that people are really focused on inflation. I did see something that's kind of funny, though, because I think you're right. I mean, you can't be a total contrarian about it. Just because everybody's worried about it doesn't mean now's the time to ignore it, because it could get obviously even worse from here. I think the point I was trying to make is that the best time to prepare for the flood is before it starts raining, right? And so if you've waited until now, you've probably incurred some pain on that front, but it's never too late to finish the job. And to that point, I saw a survey, I think it was in the Wall Street Journal. It may have been Fortune. I'd have to go back and look. And it was a survey of C-level business executives. What are your biggest concerns for 2022? They always conduct it right at the end of the year. And last year, inflation was number 22 on the list. This year, it's number 2. So, I guess it's safe to say that a year ago, people weren't as worried about it as they should have been, and now they're pretty worried about it, and we'll see where that lands on the list next year.
Yeah, so both you guys hit on the transitory as like kind of a weird phrasing, and I would just give a little more context and history to that, because where the word emerged in this inflation debate, I think has some important recent history. It was in 2011 when Bernanke used the word transitory as Trichet hiked interest rates in the face of, oil spiking while still in the wake of the great financial crisis. And, where it really comes into play is more so in terms of will there be a central bank error that causes more damage one way or another? So I think it's worth thinking about in that sense. And Bernanke was proven right at the time. Who knows what will happen this time? Although it's interesting that across in Europe, Lagarde is emphasizing the kind of opposite message of Powell here in the U.S. And perhaps that's more appropriate this time than it was last. two other things that I think are worth thinking about. One related to the central bank is, it's not, what's kind of funny is you find a lot of people, I think everyone's priors are confirmed here, no matter what they think. If you believed that there wasn't really an inflationary impulse from the monetary policy, you don't believe this to be enduring. Guilty as charged. And if you believed that the monetary policy would be inflationary, then, you think this proves you're exactly right. And one of the ironies of this all is it doesn't look like a monetary phenomenon because you don't actually see a really sharp increase in the velocity of money. It's actually still down quite a bit. So maybe I think that does add some amplified force to the transitory argument. And then, John, that's an interesting point on inflation. I would offer another side of the worrying cascading effect, the snowball effect. I tend to be a believer that the more people are worried about something, the less it actually is as a risk. And I do know that I do sense that inflation could be a little different than the typical worry on that front, because it does tend to factor into how people behave. And there could be a feedback loop that kicks off. But, the more people worry about things, the more they act in ways that might be consistent with preventing it from happening. So, I just don't know. But that's something I tend to think as not a universal law, but more of a rule about a lot of things.
Yeah, I don't know either, and I guess that's where I continue to shake out on it. But I'll bang the drum one more time. We've probably talked about this 5 times at least in the last year and a half, and that's just that when you don't know the outcome, but you know the odds that are priced in, and the odds really suck, you should just avoid it, right? And that's how I view almost all of fixed income these days, because if inflation sticks around at these levels or accelerates, it's really hard to imagine existing or prior bond owners doing particularly well, and a lot of them are going to get absolutely crushed. So that seems like an easy implication, and it may seem obvious, but it's still very true and worth thinking about, and what the implications are there to your own portfolio or to companies' portfolios, to budget situations and fiscal policy and all sorts of things, because that's one unmistakable outcome here that's going to get really ugly if inflation sticks around and rates go way up.
Yeah, I definitely agree with that. I think, there's this perception that because everyone's worried about inflation, that's reflected in the market somehow, but it's actually not reflected at all in the bond market. You look at 30-year yields on government debt, they're in the low single digits in the US. In Europe, they're virtually at zero. And, that is just ridiculous pricing given what's going on.
Yeah, it's worth pointing out, right? I mean, if you really have a strong view and you're acting on it, you're crystallizing a bet that says the most liquid market in the world is dead wrong. And it's the most liquid market in the world where, fiscal policy and Fed intervention plays a very significant role. So yeah, I agree. If you really put a gun to my head, I might put 51-49 odds, or something potentially quite a bit higher than that, I guess, on inflation really cooling off in the next couple of years. I mean, if you really think anything like the mid to high single digit inflation we've seen in the last 12 months is going to stick around, then you might as well make a George Soros style bet and just put it all on short treasuries or something, right? Because the bond market's just completely, totally dead wrong. But I certainly would never do that with my own money. I don't have that reason to believe that. I don't have the confidence behind that sort of view. So, but you do need to crystallize what that implies, right? I mean, are you really that confident that the bond market's just completely and totally dead wrong?
Yeah, that's such an interesting point, John, because, the bond guys always like to say they're the smart ones in the room and the equity guys are the dummies. And it's interesting to see, how the yield curve is actually, steepening a bit through this, which is, it's not getting crazy, but it's the opposite of what you'd expect. If inflation were really a concern right now, Well, it's not the opposite of what you'd expect if inflation were concerned, but you'd expect to see the long end budging a lot more than it is, and not being merely where it was like right before COVID. So yeah, you got to wonder what the signals are, the conflicting signals between the constant drum beating of concerns about inflation and equities without much of a whisper in bonds at all. Who's right? Who knows?
Yeah, I think before we send the wrong illusion that we have any knowledge of the future or strongly held beliefs here, I think it's just fair to say that great to exchange views on this topic, but everyone needs to know that no one can predict this, and anyone who says they can is just posturing. So, in my book, it makes sense to look for things that would protect you in such a scenario, like Phil said, businesses with pricing power and so forth. But to think that you can actually predict it, I think is just wrong.
Yeah, I totally agree. I mean, you have to be really careful with what could happen and what you need to worry about, which is what I'm trying to do, and making explicit predictions where if you get it wrong, there's a lot of negative consequences.
All right, great. So why don't we move on to Phil, your topic, please?
Yeah, sure. Thanks. I wanted to talk today about what's been going on elsewhere in the market, which is the big drawdown we've seen in some individual high-flying companies. Some people are characterizing it as a fallen angels kind of situation. These are mostly, that's technically a bond term. These are mostly equity prices that have declined sharply, and as well the related concept of investing in unprofitable companies, because for the last couple of years we've seen this massive explosion in bets on the future, and a lot of those bets on the future entailed companies that were not yet showing short-term historical profits based on their existing businesses, but investors were extremely willing to give them the benefit of the doubt and push things out in terms of valuations they were willing to pay. So what I guess it boils down to for me is like, where do you draw the line? And so this is where I'm curious to solicit your opinions and views on this, because I look back at some of the big mistakes that I have made and some of the mistakes I would have made, and they often entail a lack of simple imagination, right? Where I knew enough to make the leap between X and Y, but I didn't because the recent past or the near future wasn't as crystal clear as I'd like it to be. And by the way, just as a public service announcement at the beginning of this is not an episode of Schadenfreude. Apologize for my pronunciation there, especially to John, but as someone who speaks the German that would be required. But I'm trying to tease out the lessons here as to what we should take away from this, because the pain has been pretty astounding. And I think it's really interesting for me at a detached level to look at what's been going on. At a personal level, I couldn't care less if someone else is doing well or doing poorly, because that doesn't really teach you much. It doesn't help you make better decisions from the future. And certainly if there was a point in life where I would have enjoyed being on the quote right side of things, or watching somebody else who'd flown too close to the sun get knocked down a peg, I'm thankfully long past that. I mean, enjoying someone else's downfall is just a miserable way to exist, and I wouldn't recommend that to anybody. So that's not the spirit of this at all. The spirit of it is to look at some really unusual, really interesting things that have been going on and figure out what it means for the future. So as most people are probably aware, cash burning companies have seen their share prices just get absolutely torched in the last 90 days. For whatever reason, if you look back to kind of September, October of 2021 through this period, as we're recording this on January 20th of 2022, there's just been an absolute bloodbath in a lot of companies. A study that I read the other day had taken the loss-making companies in the NASDAQ Composite Index and showed that it was down 28% just in those roughly 85 days, while profitable companies were basically flat. They were down less than 1%. Their definition of that was an EPS below zero for at least the last 4 quarters combined. That's an imperfect measure. Of course, you could debate that all day. I think the point still stands. And they also excluded pre-merger SPACs. Although I'd point out, I mean, in a related note, that there's several ETFs that track pre-merger SPACs, and they've been crushed as well. I mean, one that I looked up was down something like 26% last year, while the S&P 500 was up 29%. So I think that's fair to say that's a pretty big underperformance. But look back at some of these numbers going back either kind of 12 months from today or going back roughly 24 months. Let's call it February 1st of 2020, right at the edge of the pandemic coming in to dominate our lives. Over the last 12 months, to set the baseline, it's weird, right? I mean, the S&P 500 was up more than 20%, about 22% over the last 12 months. Like I said, it was up almost 28, 29% in calendar 2021. The NASDAQ was up a good bit less than that. And over the last 12 months, the Russell 2000 is actually down a little bit, which is shocking. But look at some of these numbers. Rivian, which was one of the highest flying IPOs, is now down 15% since its IPO price. DocuSign, which actually has pretty useful, pretty interesting technology, was down 50% over that period. Robinhood was down 62%. Poshmark was down 78%. Zoom, that we're using right now to record this, down 57%. Peloton, which we're going to come back to, down 75%. The ARK Innovation ETF was down 47%. I mean, those are some real bloodbaths, and it's going to be really hard for investors to stomach that volatility and ride the train back up the hill, assuming that's what's eventually even going to happen, right? I mean, this is kind of where I'm going with this, is how do you stomach this volatility? This volatility is actually very dangerous. I went through a period where as soon as I sort of learned the academic theory of finance and investing, and then how flawed it was from a practitioner's perspective, and I was very dismissive of this notion as volatility equated to risk, but I've almost come full circle on it, because you see how much it does impact real people's behaviors, myself included. I mean, when you take a punch to the face like this, you can really do some goofy, counterproductive things. What's also interesting, though, is if you look back roughly 2 years ago to the very beginning of the pandemic, you still have some interesting stuff. DocuSign's still up a lot. Zoom's up a lot. Peloton, on the other hand, is actually down. And so I ran these numbers as of a couple of days ago. But just today, Peloton had some pretty negative news come out that they were ceasing production potentially. It's now below its pre-COVID price. It's below its IPO price. And I guess that's where I kind of want to take this is, where do you draw the line between the kind of first order thinking and the positive feedback loops, which John rightly pointed out in the debate on inflation, because those can absolutely matter for a long period of time. I mean, it hit me right over the head in 2020 and 2021 that this current undercurrent of sentiment can really drive its own realities for a while, the reflexivity of it all, right? And I'll never forget when people were telling me about buying Pelotons and then buying the stock because it'll pay for itself. And, I'm just waiting for X and Y to happen because it's so obvious that I'm going to make a fortune on it. And the first order thinking that really dominated the day versus the really, really significant negative long-term implications of what was going on. And again, I hate to beat up on Peloton, but we've talked about it so much, or I've talked about it so much over the last year and a half, it's worth revisiting it, right? Because there was just every sort of red flag out there you could have ever wanted, right? I mean, management got the production issues wrong in both directions, right? They were undersupplied when they needed it, and now they're oversupplied when they don't. They were spewing all sorts of nonsense and talking about how they sell happiness. And I mean, it's a stationary bicycle, right? I mean, it's not selling happiness. That's total fluff and nonsense. The ad campaigns they ran that were just disastrous and so cringe-inducing in every possible way. And I'm talking about before the recent debacle with Mr. Big on the Sex and the City reboot. The 13-year estimated average life of a subscriber that they were using in their self-promoted investor relations metrics, that was just categorically ridiculous. Like, I'm sorry, this could have worked out differently, I'm sure, but that would have proven ridiculous 99.9% of the time. I mean, there's just no reason to believe that anybody's going to continue to pay for a subscription for an exercise product for over 13 years. It's never happened before. There's no reason to believe it's going to happen again anytime soon. So, I guess this is where I want to kick it over to you guys, is where do I draw the line between a company that has a bright future but is making a loss now, and a company that's just better left, until later, even if I give up some of the upside. So of course, what everybody loves to point to is something like Amazon or Costco or Home Depot or, I don't know, some of the other big home runs where of course they posted losses early on and even for a period of years. And that's great. And I guess where I draw the line is that those companies were self-financing. They didn't need to go back to the capital markets all the time. And their investors weren't out, and their insiders weren't out dumping stock on the market. And where the unit economics made sense. Because, again, I don't understand how a $2,000 to $3,000 home exercise piece of equipment ever really made sense at scale, but a Costco store or Amazon's online retailing effort or whatever, those always made sense, right? It was just a question of what's the right price to pay and how long do you have to wait for it, which is hard enough, right? But when the unit economics don't make sense, when the business isn't self-financing, and when insiders are dumping stock, I mean, those just seem like a bright line test for me. So what do you guys think?
So I have a lot of thoughts, but no answers. And it's something I've been struggling with myself, and I'll get to that in a second. I would take a little bit of the other side on Peloton, insofar as when I first heard about Peloton, which was when a friend's cousin, led the angel round, I was like, that's the dumbest idea I've ever heard. And fast forward to the early pandemic, and my wife was working from home and no longer going to her office gym. And I have had a spin bike in the basement for over a decade, used regularly. So I was resistant. She's like, let's get a Peloton. And I love the thing. And I'm addicted. I do the strength classes as well. So not just the bike classes. And I think it's one of the best products I've experienced. I thought it was on par with prior spin bikes. I think there's a big market for it. I think they got way over their skis in forecasting demand. And where I draw the line on unprofitable versus on unprofitable businesses, I think you got to it. You said unit economics. It's all about the unit economics. For me, I don't want to go near a company where they need more scale to make the unit economics work. But if they have proven unit economics and they're investing with disciplined ROI and driving upwards their customer or store base, that to me is a good recipe. And I think, that discipline in driving things forward is where Peloton fell short, because their economics do work. Their subs actually are quite valuable. Maybe not 13 years long, but I think they'll stick around. And, I'd imagine a household like mine where, even my 7-year-old really wants to use it badly, we'll end up with several amongst the 4 of us one day in the future. But, you can't just invest over your skis in other fixed costs, not in scaling your unit economics. That was like just atrocious management. Now, in terms of like this general environment and the punishment that unprofitable companies are taking, I'd argue it goes way beyond merely unprofitable companies. And I say that as someone who's sitting here for the first time in my career. I'm holding something like Roku, where, in the beginning of January 2021, I sold a portion of my position and had a client be like, why would you sell any of that? This thing's done so well for us. I presented this at MOI in January of 2019 in the Best Ideas Conference for context of how long I've been involved in this thing. Sold a little, and it's like, why would you sell any of that? I'm like, oh yeah, I know, tough, tax it, whatever. And you fast forward to the end of the year at a different client, like, how are you so stupid that you didn't sell all of that position when it was much higher? And by the way, it has not had a good start to the year. And I've really been wrapping my head over, because Roku is profitable for the first time in its history. They've been generating cash flow while trying not to be profitable. They have unit economics that actually work, that you could kind of break down pretty cleanly on a household basis. So it is a real business. You could see exactly where the cash flow is coming from. Management's been disciplined in investing toward it. But hey, it's been trashed with everything else. And, I think one of the other questions is relatedly is not just like, which ones do you think about from an investment perspective, but how do you think about your ability to hold or not hold something through an experience like that? And what does it do, to see that happen? I could tell you, it has not been fun. A couple of the stocks that I've talked about here, PayPal is another one where it's like, they're very profitable. They have really high margins. Like, it's a pretty sound business, but the market has treated it like some of these other unprofitable companies. So I think there is some sort of combination of I don't think it's merely about these companies being unprofitable. I think it's about like the difficulties in extrapolating the trends from COVID, and to what extent are some of these trends going to regress to trend as opposed to mean, right? To revert back to their prior trend level. And it seems like that's something that's happened already in e-commerce sales in particular. Versus to what extent did like excess earnings in that period perhaps bring in new competition to some of these names? I don't know. But there's a lot of, I think you go back to our episode, I think it was like maybe 4 weeks ago, where I talked about the difficulties and challenges of forecasting your business in a time like this. And I think that's part of what I think about too. And then you do add in the fact that, yes, in this environment, there was a lot of speculation. There was junk that absolutely did not deserve to be where it was. Like you mentioned, Rivian. Yeah, absolutely. There was Nikola, which I think is even crazier to see and have witnessed than was Rivian. There's I think just a lot of weirdness, and I don't have answers, but I have definitely felt what you're talking about, Phil, where it's like, how do you stomach some of this volatility? My God, having ridden the Roku train for quite a while now, it's like a great return, but also very hard to manage. And so, I'll leave it at that for now and see what else comes to mind here.
I have a couple of reactions to that I think you raised that were good points, and a couple of things. One is, I don't think this is all just a story about junk or not junk, right? So let's take something like Rivian. I'm rooting for Rivian to succeed. I'd love to see this country produce another good manufacturer of electric vehicles. Like, that'd be great. And they've got some amazing backers behind them, seemingly some good executives that are not, unlike Nikola, being disingenuous. It's just kind of crazy that this is a company that's going to be loss making for a long, long period of time and need a lot more capital to get up and going, to see the valuation that was afforded it at its IPO and very quickly then taken away. And that's the danger, right? That's where I just don't know where to draw the line. On the flip side of that, to your point about being an early stage investor, look, I think this is one of my weak spots. I think it's why I'd probably be a pretty terrible venture capitalist, because you could come to me with lots of ideas that would work out pretty well, and I'd probably pass on almost all of them. And so if you're an early stage investor in Peloton, you're probably still going to end up with a great IRR, even though the company's now well below its IPO price and has been a loss maker for almost all of its public market investors. But there again, that's the lesson that I'm trying to tease out of this, right? I'm not at all trying to add to the train of people that are dunking on Cathie Wood all the time, like she's getting enough negative attention seemingly every day. But what is pretty astounding is that the ARK Innovation Fund will still have a significantly positive lifetime IRR. But if you take the assets that were in the ETF at the various points along the way and time weight it for the flows in and out, it's now produced a net loss for all of its investors, right? So it has lost more money in raw dollars than it has made in raw dollars, even though the IRR is positive. And that's a really important point that I think a lot of people miss. And that's why value and valuation and price matter, is because if you get that dead wrong, you're just transferring wealth and you're on the wrong end of that transfer. The other thing I'd say that really strikes me as crazy about this period is that even though there's been a ton of blood in the streets lately and a lot of people's performance has really been suffering, I mean, look at some of these numbers, right? I mean, the overall market is still up enormously. The NASDAQ is up 71% over the last 2 months. The S&P 500, or 2 months, 2 years since the beginning of the pandemic, the S&P 500 is up almost 50% over the last 2 years, over the course of a raging pandemic and all this inflation and everything else that's gone wrong in the world. Like, this has been a historic boom in the markets. And now we've had this, sharp pullback over the last couple of months in some individual names. But even something like Roku that you just brought up, right? I mean, so you said you were talking about that in January of 19. Is that right? So, I mean, from that point, it's still quintupled or more. So, I mean, this has not been some sort of loser over that period of time, despite the recent painful, sharp sell-off. It's just had a big spike and then it's had a partial pullback. And, that's kind of life. And, to further the point there, I mean, that is one where it's really just a question about valuation, because there's a very real business that's self-financing there. And it's not a business that needs to go out and continually issue equity. Or in the case of Peloton, say they don't need to issue equity right before they do issue equity. So, that to me is, one of the places where I would try to draw the line.
Yeah, one of the things I struggle with, just to put it succinctly, is I've always been gearing myself to be a long-term investor in things and hold with very low turnover. At time, I formerly put out an explicit turnover target. I've since, tried to soften that to make sure it doesn't become a constraint in the wrong way. But, you sit there thinking like, okay, this thing's due for a period of digestion, which means it probably goes sideways for 3 years, and instead it goes down 60%. The consequences of sideways 3 years versus down 60% in short order are very different and feel very different psychologically. And it's like, that's one of the challenges. So that's the question.
Yeah, that's a great way to frame it. And another kind of twist on that I use to look back and say, was I right or was I wrong? Because I can look back at decisions I made 2 years ago, 5 years ago, 10 years ago, and it's really hard to say, was that a good decision or a bad decision, just because you can't play the pure counterfactual. The world changed, the odds along the way were shifting. But I think a good way to kind of account for some of that is if I had been in a coma for that whole period of time and unable to act on those shifting odds, did I have enough room for error at the beginning such that I still got a good result? And so that's where, it speaks to both sides of this, right? Because if you had made an investment as a Series A investor in Peloton, you should still be really happy, even though as a public market investor, you're probably pretty miserable. So, it just depends on who you are, where you invested, what price you paid, and how much you can kind of shut your eyes to the volatility swirling around you and avoid being overly influenced by it.
Yeah, I guess I'd just add, generally have a really tough time with unprofitable businesses. I don't know what the base rates are for something like Amazon happening and actually picking that kind of a winner. For me, it's actually easier to pick unprofitable businesses in cyclicals where I believe, hey, when that cycle turns, these guys are going to make a ton of money again. I can see that, investing in unprofitable businesses that are doing something new like a Peloton, and this doesn't apply to Peloton, but just those types of companies, I think if they're in clearly scale advantaged industries, maybe where there's going to be a natural monopoly, a dynamic, a winner take all, you can make the case that you want to be with that 800-pound gorilla, even if it's unprofitable right now. But again, I have a tough time, distinguishing between that kind of a company versus a company that actually looks like it could be that dominant, but actually is not going to get anywhere close to that. I think, Tesla is an example where people disagree, but I feel like, yeah, I can see how, that's a really important sector, and there could be a big winner there. But I also think that, the existing automakers have such huge resources that, they're going to put up a very, very stiff fight, and they have brands, they have knowledge of the auto business. So I just couldn't make any kind of a long bet on Tesla for sure. But if you look at the valuation, even if this company ends up being dominant, it's not clear you're going to make money as a shareholder. I think in terms of the volatility and all of that, I feel like because of the success of some high-profile long-term compounders like Amazon, and then the bull market that we've had over the past couple of years, there's also almost been a little bit of a fetishism around buy and hold. And a lot of people who maybe have a value mindset when they buy into a stock became a lot less valuation sensitive when it comes to holding on or trimming than I think value investors have been in the past. And but you have examples like Buffett not selling Coke back in the late 1990s, which admittedly was a mistake. But I feel like if you actually are valuation sensitive, at least to some degree, you could do much better than just a buy and hold strategy, because sometimes these things do get ridiculous and then they can actually go down substantially before, again, they embark on a multi-year uptrend. So those are just a few.
I needed this talk from you, John, 7 months ago, maybe a year ago.
Yeah, easy for me to say now, right?
Yeah, it is. I mean, that's the point, right? It's very easy to say. That's kind of where I was getting at. Like, it's so hard to look back and say, did I make a mistake, or was I just, slightly wrong in a way that I can live with? Did I just get victimized by, the odds that I knew were there, and the 1 in 4 chance turned up, or something like that? I mean, it's really, really hard. But I think I've gotten better over the years at just being willing to draw the line around things where I'm just perfectly happy to be wrong. And, one inescapable truth that has just continued to come up over the last year or two as I look at some of these types of companies is that if you're making losses today, they must be actually made up in the future in terms of the present value, right? I mean, I talk about this in my MBA class. Can we all agree that the price you should be willing to pay is the discounted present value of all future cash flows? And everybody agrees, right? Yes, that's true. And so let's hope, because if we don't agree on that, we need to have a different conversation. But if we agree that that's the case, then we need to start talking about what those future cash flows are going to be and at what discount rate to discount them back. And that's where things, of course, get interesting. And I think what's been so amazing is people's willingness to suspend disbelief as it pertains to some of those, right? I mean, their own numbers don't justify the prices that they were paying for some of these companies, and yet they persisted because the narrative or the momentum or the belief or whatever just kind of carried them along. And that, to me, I guess, is the ultimate lesson here: is you can't let that happen, as tempting as it can be.
And by the way, I'll just add one thing where, I talk about the buy and hold not being so great if you're valuation insensitive, but I make the much worse mistake, which is I tend to sell out too early. So I'm too valuation sensitive, and I guarantee you that I've missed out on a lot more and therefore lost more money than someone who maybe holds on too long. Because if you don't actually make money on ideas that you're right on, then I think that's the ultimate mistake.
Yeah, I agree. That's an easy mistake to make. That's pretty related. That's a good point.
Yeah, that's the toughest struggle. Buffett's told about how some of his biggest mistakes are of omission, which I view, like maybe not selling Coke, but also not holding certain things, like not holding Disney from when he had it, for example.
Not buying Walmart, not buying Costco, right?
Yeah, and I think one of the answers I take away from this all is it is not supposed to be easy. Right. You will go 1 year saying my biggest mistake was not holding things, and you'll go the next year saying my biggest mistake was holding everything. And it's really hard to make sure that you take the right lessons out of things and focus first and foremost on process over outcomes every step of the way. And I think that's what we need to distill. And one of my friends said to me, like, the key is don't reflect on these things from inside yourself, reflect on them from outside yourself, and make sure you're looking at it with a degree of separation and honest perspective. Because I do think, like you're saying, John, you could say on the one hand, we got to be valuation sensitive and sell. And on the other hand, part of saying I sold too early is, I was rightly valuation sensitive at the moment I sold, but it did something to catalyze and justify a yet higher valuation down the line. And I'll go back to Roku. Like the first time Roku got expensive, within a year of me buying it, it was at $60, but it was not worth $60 at the time in my framework, though, because of my tax sensitivities, I was like, I'm not going to sell yet. But if you fast forward 12 months later, $60 at that time was like a really, really like screaming buy. And so, it's really hard to have that perspective at the time. And I think it's just hard to get right.
Yeah, absolutely. That's the balance that's so hard to strike. And I think, investors keep learning and relearning that for their whole investing lives. So I think we're condemned to Never really find that answer, but hopefully get a little bit closer to it over time. Guys, thank you so much for another fascinating discussion. I hope everyone listening enjoyed it as well. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.